But today we're going to talk about investing in entrepreneurial startups, and kind of let's subtitle this thing kind of the mindset of the investor, to kind of get you that are entrepreneurs or working with friends that are entrepreneurs, some kind of feeling of what the investor is thinking about when you go to them and ask for money. So that's kind of what we're kind of the theme of what we're gonna talk about today. First thing to keep in mind is, so an investor is fixing to put money into a startup. From their point of view, this is a really, really risky opportunity for them. So kind of the national statistics, we've got some funds around here that have done a little bit better than this, but kind of the national statistics are, if they invest in 10 startups, 2 of them will return some pretty good money. A couple more will return basically what you put in there. The rest of them, you're going to lose all your money in. That's kind of the average statistic. So the investor can go out right today. You can buy a 4% CD, real safe. You know, you're not risking much of anything. It's federally insured. So even if the bank crashes, that money's still there. So very low risk. So if the investor takes money and puts them in this startup, and we just said you had 6 out of 10 chance of losing all of your money. So those 2 that are successful have to generate enough money to cover the losses on all the rest of them. So that's kind of the mindset that they're thinking of when they're looking at your company. So that means when they come back and say, well, I'm looking for 10 or 20 or 30 times my money, that sounds horrible, but think about it. They're covering the rest of they have this basket full of investments, and this basket full needs to return something better than that CD rate because of the risk they're putting it in there. So that means those couple have to do really well to even come out even. So that's kind of the mindset of where that's all coming from. There's various levels, obviously, of where this investor might put their money in. Very early stage, it's an idea. It's an idea that's had some development, some level of team's been put together. Maybe some development's been done on the product, whether it's a service or a product you can hold, or software or whatever. And then you've got one of those that actually has some product in the marketplace, and they're starting to grow. Then the third kind of category is they're cash flowing. That means they're paying all their expenses based out of profit on sales. So people invest in these different levels, and then the last one is kind of they've been cash flowing. They've got some history of that, and some more money put into the company could really help them grow and get really large. Of course, that's what that early stage investor wants, is I want to put my money in real early while I can get a pretty good value for the company. And then it goes through these other stages and eventually takes off. Now that person might put a little bit more in those later stages, and they may not. Hopefully, from your point of view, that this is somebody that's got some expertise in something that's going to help you. It might be in business processes. It might be in the industry that you're in. It might be actually related to the problem that you're trying to solve. That would be nice, but sometimes it's just funds, and they have some ideas that can help you along. Now that last group that we're talking about, really helping the company accelerate after they're profitable, that's typically venture capital money, VC money. And those folks, people will tell you to go out and kind of work with them and start getting them knowledgeable on your company, and that is helpful. But kind of ask on the front end. They have usually pretty narrow industry focuses that they invest in, things that they're knowledgeable on. And typically, each one of them are going to have some kind of minimums that they're going to talk about. I want to see $3 million a year in revenue. I want to see $10 million a year in revenue. Those kind of numbers, or you might say, I want to see, $5 million in revenue and profit on the bottom line. But if you think you're going to be getting there, letting them, kind of watch and see what's going on for a couple of years before you're ready for that money can be helpful. But thinking you're going to go to one of those kind of funds and get funded for your early stage company, you're kind of wasting your time. If you think because that's just pretty much not going to happen. So those are the categories kind of in which the kind of companies that investors invest in. Now let's talk about some of the kind of things that need to be going on in the company before an investor is going to think about investing in you. One, they have to really see that there's an opportunity for return of their money. So some of that kind of falls in a couple of different categories. One of those categories, or whether you're a lifestyle company, we've heard that term, or a more growth kind of company. A lifestyle company, there's nothing wrong with that. This is a company that's going to produce good revenue, can be profitable, gives you a good lifestyle to cover your family and help you be successful and live a good life. But that probably doesn't mean that it's going to generate the kind of revenue and profits that's going to give a good return to an investor. So those type of companies, if you're going to get any money for those, are typically going to be a friend or family or rich uncle or whatever, and it might be a different kind of investment rather than buying a piece of your company or an equity investor. And we'll talk some more about some of those categories of types of investments here in a minute. So one, that investor is going to be looking to see, can I get my money back? Is there a good chance that I can get a good multiple on my money? Can I get that 10 times as much money back within X years, 5 years, or whatever, which means there's going to be a lot of growth, right? A lot of sales going on there. And then they're going to look at what is it that the company's going to do. So what is the product or service? What's the problem they're trying to solve? So those of you that have studied Lean Canvas, that's that key piece you started off on. So they're going to look at, are you solving a problem or making something easier, better, cheaper, more efficient than however it's being done so far? So what is the problem? Does it sound like you have a really good solution helping to improve it? Is there technology involved? Lots of times these big multiples come with technology that make things really that faster, cheaper, more efficient, or solves a problem that's been totally manual before. I mean, that's always a good category. They may look to see, is there any intellectual property there, patents, those type of things. If you don't have a patent, doesn't mean you can't raise money. I know that was a double negative, but be sure you recognize it. That's not an absolute requirement to raise money. But if you have patents and they're really going to protect the space of your product, that's going to make it easier for the investor to make a nose. And then the next thing they're going to look at is the team. And the first three criteria that really make a difference to the investor is team, team, team. A fantastic idea that really solves a significant problem that doesn't have a good team working on the problem is probably not going to make it or not going to do real well. The team can take a not so wonderful product and make a great company out of it. That happens on a regular basis. There's some gigantic companies that's true of. Microsoft did not have the best operating system, for example, but they had one heck of a team. So that's kind of the concept there. And early on, if you're one of those early stages and you're going out there to hire to try to raise money, you probably don't have all your team there. That's not necessarily a problem to the investor, but what the investor is looking for is, do you understand what the team needs to be? You have a plan to get to the point where you've got the right team there, doing the right things. And it's okay to say, yes, I'm going to need a CFO or a chief marketing officer or something like that. And I know I'm going to need them, but I don't have them right now. I can't afford it yet, or I need to work on my product some more first. Recognizing that it takes some more team. The companies that have maybe a really good founder and a good product solves a significant problem, where the founder is doing everything, really is never going to be big. Very, very seldom. That's very rare, because they need those other members of the team. And if you're out there, building your team, another thing that's really important to recognize to me is a multi-disciplinary team. If you see a team that everybody's got an engineering degree, or everybody's got a business degree, or it's music oriented and they all have music degrees, you don't have to have degrees, but as examples, that's much, much harder to be successful, because the things those other folks bring to the table are ideas and problem solving skills and just knowledge on how those other segments work. So multidisciplinary team strengthens the vision that the investor is seeing too. So look at your company, and if you see you're all kind of buddies because you were all in that one segment of education together, think about what else is out there and what else that you might need. And obviously, if you're going to the venture center and getting mentoring and help with all of that, some mentor's going to pretty quickly probably point that out to you, that you need to be looking at some of these other folks. So some of the things that you need, some of the things that your investors are gonna want to see. We mentioned Lean Canvas. That's a really great tool because it forces you to think through those 8 or so categories and define your problem real carefully. Define what the solution is, define what the potential customer base looks like, what are their characteristics, what channels are you going to use to take it to market, all those type of things that you can get defined in theory on one side of one piece of paper, but sometimes it gets a little longer than that. But that's pretty valuable to the investor to see that. Pitch deck is almost absolutely required, because you're going to give your summary kind of what the company is, what you're trying to go. The Venture Center has a great outline for that if you're looking for something like that. A term sheet is always helpful. What's in the term sheet is, I'm looking for X dollars. I think my company's worth Y dollars. I want it in some form of investment. We'll talk about what some of those potential forms of investment are in a minute. And this is kind of how you're going to get your money back. Are there any special characteristics I'm going to give you if I'm selling stock? I'm going to give you some kind of preferential return. Those type of things. There's usually, like a 1 or 2 page kind of summary of the deal that you're trying to sell to the investor. I always want to see a pro forma, a layout of your accounting, of your projections of where the company's going to go. Investors generally recognize that that's somewhat of a crystal ball kind of activity. But what I'm looking for when I read a pro forma is, okay, what have you thought through? What have you thought through about what the different costs are going to be? What have you thought through on pricing of your product and how many you have to sell to generate the revenue? But the real thing I'm looking for is, what have you left out? What have you not thought about? What are some costs that you haven't figured out, or what are some costs that you've got in there that are obviously way off base? That doesn't mean that'll definitely kill the investment, but it means you've got some work to do and you need some mentoring from somebody to help you kind of figure out the rest of the pieces, because what's missing is much more indicative of your thought process and where you are in thinking about your company than all the pieces that you have there. So let me take that about what's missing. The other thing, the investor, and this is pretty true of all of them, they're looking through all of these things we've mentioned, and interviews with you, your presentations, questions, whatever, and they're looking for, again, what's the likelihood I get my money back and with a profit? So they're looking for, what's that ugly scar that's in there that might make the company fail? Is there somebody missing on the team? Is the team leader's not strong enough? You don't have a clue what it's really going to cost to produce the product because your pro forma just doesn't make much sense. Unfortunately, what happens to you, and the reason you got to go talk to lots and lots of people to ever get your funding, is it only takes one of those scars that investor sees to get a no, and then they don't want to talk to you anymore, saying they might go, well, go work on this, and when you've got it done, come back and talk to me. That, at least they've told you what their concern is. They've told you, here's a piece I think is missing. Go work on that. This is a little bit, probably, I don't know whether I should tell this, but I'm going to. Y'all are all familiar with Apogee? Well, our angel fund was the first one to invest in them. And they came back, Justin came back 3 times before we ever invested in. Went off and we said, well, we kind of like your idea, but I don't think you have it all put together. Go work on this. 6 months later, he'd come back and he says, I've worked on that. And then we go, well, we think there's still this other problem. Go work on that. He'd go work on that. Came back the 3rd time and we go, man, he's working hard at this and he's making good progress. Looks like it's coming together. And then there was the first investment. And that was the first money he got. But he had to, and I think it really was almost 18 months or so. And he worked at it and he came back and he eventually got the funds, and then came back and the fund invested in him a 2nd time later as he continued to put it together. But so if you can get that no that you get from many of the folks you talk to, if you can get them to tell you kind of what's missing, what do you see that's a problem here, they may not say fix that now, look at it again, but they're telling you something that they see that you need to look at. So try to get that out of a no you get, so that no can be valuable. So forms of companies, this question comes up. There's an S corp, an LLC, limited liability company, a C corp, which is kind of a normal corporation. Only advice I have for you on that is an S corp. There's practically nobody will invest in an S corp. You'll hear people say people want to invest in an LLC, but that's just really not that lots of people invest in LLCs, and people will tell you, well, you can't do a lot of the things you need to do with an LLC, and that's not really true. either. You can do almost anything with the LLC you can do with a C Corp. Now, very often it is true that once you get to those venture capitalists, companies are really grown, it's big, you're doing well, they're probably going to want to see a C Corp. You can do a flip over to a C Corp at that time. The advantage of an LLC, and the reason many investors like it, is there's a real tax difference between a C Corp and an LLC. In an LLC, whatever the company is doing, whether it's a loss or whether it's a profit, they don't pay any taxes on it. And that loss or profit flows through to the owners through a tax form called a K-1. And that goes on the owner's taxes. So early on, first few years while the company's losing money, those are losses that are coming through to the investor's tax return and offsetting some other income they're having. So they're saving taxes. So they're actually and effectively lowering the cost of the investment in your company by saving some taxes. So that's why many investors kind of like an LLC on the front end. And maybe when it starts being real profitable, you want to flip it over to a C Corp so you don't get all that income on your taxes, but you still have the disadvantage of the C Corp has to pay taxes on its profit. And then the only way to give you, the owner or the investor, money back is to do dividends. And so you take $100 profit, you pay $30, $40 worth of taxes on it to the state and federal government. Then you take that $60 are left and they pass it on to the owners, and then they pay their 25, 30, 40% taxes on that. So you've just paid taxes on the profit the company's made twice, once at the company level and once at the individual level on the money that you got through. But that's typically the way the VCs want to see a company. Yes, sure.
As you just enumerated the advantage of LLC, that's where
has those advantages from a tax point of view, but from limiting liability and the ability to do options and warrants and all those type of things are not there for an S Corp. It's from a liability point of view for the owners more difficult. And that's why typically it doesn't have the same level of governance documents. It can, you can go to a lawyer and put in a complicated governance document for an S Corp, which is really an agreement amongst the S Corp owners. But an LLC, there's thousands of example documents out there. You can come pretty close to getting started without nearly as much front-end expense. If you want, and you should want, to have their governance taken care of. That's another important thing for the company to have, is somebody on their board or in the investors or somewhere that's really pretty familiar with governance. And I do a lot of that in companies I work with, but if that's going to have to all be in order for any kind of sophisticated investor, and for sure when you start getting to the more sophisticated or the advanced investors. So that's kind of some of the comments that I had written down here. But when you're talking to the investors, don't try to hide stuff. They're going to find it. Be open, be transparent, let them know, and telling them here's an area I need help in is real positive, because they go, oh, I've got a friend that knows about that, or I know about that, or I know an investor that has that kind of stuff. Let's bring him or her in also. So why don't we just kind of stop at that point and see what kind of questions we've got. Questions?
Guess we're in the early stage company, it's not quite as much history built up on.
Mhm. Right.
So what would that? Younger company, is it basically, it's our cost structure and your growth.
Yeah, it's going to look basically like an income and expense, a regular income and expense statement where you talk about all your different kinds of income. If you have cost of goods, manufacturing costs or whatever it is, cost of goods, all your expenses, and your expenses broken down into a bunch of different categories. They want to, see all those different categories. And then down at the bottom is the profit or loss for that period. 2 or 3 years, trying to do a pro forma for 5 years is, in my opinion, crazy. 3 years out's pretty crazy to start with, but 3 years kind of gives them the investor a feeling of where you think you're going and what you think it's going to cost. And then you don't have to do it, but typically I like to add, use down at the very bottom, a running total of your losses, and then they're converting to profit. And somewhere along there, wherever that biggest negative number is, that's how much money you need to raise. That's how much money you are projecting to spend that you don't have. So that help? Okay. Okay.
How many times have you heard that entrepreneurs say, back in the $4 billion market, and I can only just get 1%? What are your thoughts?
I think you know my thought on that, but that's kind of BS. It's what the investor wants to know is, okay, yeah, it only takes 1%. How are you going to get that 1%? What's your go-to-market plan? And you'll hear those questions. Those of you last night, you heard that question several times. What's your go-to-market plan? How are you going to sell this? So it's, what's that revenue going to be in the pro forma? And how are you going to generate that revenue is much more important than what percentage of the available market it is. It's good to know that you're think a small percentage of the available market is there, because that means if you really take off and you get that VC money down the road, that you can go up and you can sell a whole lot of money. Another thing I need to say on top of all of this, we've been talking about fundraising. What's the very best source of funds to grow your company? We mentioned several different things here. Revenue. Don't take somebody else's money, generate income. Then you don't have to give up part of your company. When you're selling equity, you're selling, a piece of your company. That's a unit if it's an LLC, a share of stock if you're a C Corp. The lawyers that wrote all of the LLC legislation decided everything that's really the same as a C Corp needed a different name. So stock, unit, same thing. So you just got to learn to a board of directors, a board of managers, same thing, but they just kind of have different terms. Other questions? Okay.
Thanks for coming today. So, looking back, say last 7 years, what are the most investable companies seen in Arkansas? What are the commonalities that
Well, the commonalities are kind of what I went through. They've got the right problem they're trying to solve. They've got a good solution for it. It either improves something that's already out there. Another favorite kind of don't ever say it to an investor is nobody else is doing this. That problem's out there. They're solving it some way. It may be on a yellow piece of paper, but there's some other way it's being solved. But it's having that right problem, having the right solution for it, knowing how you're going to market, and most important is, the right team. So, locally, Apache's, one of those good examples. Mo Vista up in Northwest Arkansas is a good example. Safe Foods over here finally got there. Took them forever to get there, but they've got a big bustling company over there, and they sold it, and all the investors got their money back with profit. But there's a lot of very successful companies out there. JB Hunt, Walmart, all of those folks, those were all startups that started here in Arkansas.
Do you want to talk about how the dynamic changes in conversation with the investor and equity tax credits are available?
Sure. Equity tax credits are a really neat incentive from the state of Arkansas. You go to Arkansas Economic Development Commission to qualify for those. They give you, the investor, 1/3 of what they invest as a tax credit that you can take off on your personal taxes. So you just discounted your investment by 33%. Now it only qualifies, has to be a targeted business. That's a set of definition in the state law, but typically think of that it's some technology oriented, and technology oriented is pretty broad statement in that law. It includes all different kinds of companies. Typically does not include manufacturing unless it's a real unique technology product. And typically it doesn't include, services kind of companies, law, medicine, accounting, those type of things. But it's a super incentive. There's a bunch of incentives from the state that can help startups, and Accelerate Arkansas was basically the one that wrote all of the incentives for the startup companies and got all that legislation passed. So that's a great incentive. Keep that one in mind. Yes.
And how do investors feel about products in the R&D?
That's a really good question, because it partly depends on where it is along the R&D level. The things that are still kind of an idea on the back of a napkin kind of thing are pretty hard to get folks to put money in initially. That's typically friends and family. Is the group that's called literally friends and family, that kind of like where you're going. And obviously, as you go through the process in that R&D, more people are going to get more interested. It's kind of, how far along is it? How risky does it still look like to get there? But a lot of the angel funds will invest in things that are still kind of in the R&D stage, but they have to kind of see a bunch of those other things together, the right team. So unfortunately, I can't give you a straight answer on that. It kind of varies a lot. Right, exactly. Another thing I want to tell you about, there's a group in Arkansas called the let me get the name right here. Archangels Alliance, ARK Angels Alliance. It's an angel network. You can search and go to their website. They have angel investors as members, and there's also a place on there for you to key in the information about your company and apply. They have an investment committee that'll select a couple of companies to present to their members each month, and they will you'll present to the members. The members will decide where they're interested in each. In this one, it's a network versus a fund. Network means each person makes their own individual decision whether to invest or not. But it's been pretty effective. They've been in business about 2 months. They've been 2 years, and they've invested around $3 million or so far in different companies. I think almost all of them are in Arkansas. So it's Arkansas focused, but they do accept companies from outside of state. Other questions? Comments? Yes. That varies a lot also. Some of them that see just a real strong opportunity that may take quite a few years to get there will invest. There's fewer of them that'll invest if that time frame looks more than, say, 5 years. You'll find a lot of folks that are accredited investor, and we haven't defined that one yet either, but accredited investors really pretty much what it takes to invest in these kind of companies. But there's a lot of them that made their money in, things you can kick and touch and, real estate and banking and all of those type of things that aren't very comfortable with this kind of investing that we've been talking about. A lot of them are, thinking 1 or 2 years kind of return. But there's a lot of angel investors that 5 years they're kind of comfortable with, and that'll kind of drop off over time. But you'll see folks that'll be fine for 7 years. If it's looks like that there's really something powerful that can get there, and realize there's a reason that it takes that kind of long for development. So I'm sorry, this is another one. It depends kind of answer. That's another it depends question. If it's IP that makes you super unique and you got all of the other pieces in place, it can increase the value and it increase the interest in the by the investor. So early on, I mean, if it's something that's going to really change the marketplace because it's going to give you an absolute monopoly for your whatever 27, 30 years, whatever it is, it's going to make a difference even on the front end. And in fact, if you don't have it at that point and they see somebody else can run off with the idea, that's a negative. So if you've got it and it's powerful and it's really going to save you a slot in the marketplace, it's valuable. Yes.
But it takes them a couple of years. So at what point in company's development life cycle would you recommend first reaching out to a VC to start forming that relationship?
I'd say when you're starting to get close to cash flowing. And I mean, if you're really growing, getting to that, if anytime you've got a good growth curve, go ahead and get in there. So it's I'm starting to see when you're going to get to profitability. It's kind of projectable, and that you're growing to the point you're going to get to whatever their minimum revenue is within a couple of years. Be careful. I didn't say that you had to have that 2 years to warm up. I've seen folks go to VCs and get money in 3, 4, 5 months, but it means you're kind of already meeting most of their checkoff boxes. What I was trying to say is if you're kind of headed in that direction and you can sell to them that I'm going to get there within a couple of years, just be warming them up during that period, because they'll start watching you and asking you questions, and them knowing more about you is going to make it easier for them to make a decision. Okay, so one last quick question. Yeah. I'm sorry, say that one more time. One is you can come to the Venture Center and we can tell you about it. But the Arkansas Economic Development Commission is in the Department of Commerce, is who manages those incentives. And the ASTBDC, I get it right in a minute, also has information. They can help you. Okay, well, thank y'all for coming today. I've enjoyed it, and come to the Venture Center and get some mentoring if you want to know more about any of these things.